We'll talk about how value investors trade options, what option selling strategies do we use for long-term investing. Hi, I'm Henrik from Value Investing. If you want to expand your financial skills, make sure you subscribe and hit the bell icon not to miss anything. And if you prefer to see subtitles, they are available. In this video, I'll show you how I trade short-term options with value investing long-term principles. I will show you how I buy stocks cheaper than the market price and how I sell them later higher than the market price. For instance, the stock is trading at $33, but I buy it paying only $30. And when it reaches, let's say $56, I sell it and get $60. So I pay $30 and get paid $60, even if the price didn't reach $30 or $60 ever. But before we start, please make sure I'm not a financial advisor and I don't provide any investment recommendation. This video has only an educational purpose. Before you invest in anything, do your own research and analysis. Also, option contracts are considered as high-risk investment tools, so please don't do any trade until you get enough education. Okay, let's move on. Let's say I've done my full investment analysis for a stock XYZ and found out that $30 is a great buying price for me, including the margin of safety strategy. But the problem is that XYZ is trading at about $33 to $35, and I don't know if it will drop to $30 or below that ever. Meanwhile, I'm not going to pay more than $30 for the XYZ stock. I really want to own that stock, but my investing rules don't let me buy it at $33. And I always try to act in accordance with my investing rules. Let's continue. On the other hand, the price can rise from $33 to $40 or $50 and never come back. I will not be happy if I lose the opportunity to own this stock. But the advanced investors should position themselves in the market in a way that makes them happy however the market moves. The intelligent investor should be prepared for all directions. So what should I do to own the stock for only $30? There are actually many ways to play it here with different option strategies, but I'll cover only one of them in this video. Stick to this channel to learn about the other strategies as well. So in this case, I sell a put option as Warren Buffett does. I sell a put option with a strike price of $31 to $35, depending on the premium size and the expiration period. When I sell a put option, let's say with a $32 strike price and let's say with a 1 month expiration period, that means that I get paid in the upfront to promise that I'm willing to buy the XYZ stock at $32 if the price drops to $32 or below. And in this example, I get paid $2 per contract for the promise I've made. To sum up the case, I promise to buy the stock at $32 for what I get $2 in the upfront. And as always, three things can happen. The price can go up, down, or stay sideways. So if the price drops below $32, I will be happy to buy the stock, paying $32 and getting $2 in the upfront, so that my cost basis will stay at $30. If the price stays sideways, I will pocket the $2 premium and will sell new put contracts. And finally, if the price goes up, I will lose the opportunity to own the stock, but instead I will still pocket $2 per share on the stock I never owned. In short, I will make money out of thin air, or I will buy the stock I want to buy at a price I want to pay. There is no other outcome, and that's what is called advanced investing. This put selling strategy is called a naked put or a cash secured put, and it is a very powerful strategy when you combine it with value investing principles. Otherwise, many people lose a lot of money doing it wrongly. So in this case, I buy the shares paying only $30 regardless of the price dropping to $30 or not. It can stay at $31 and I still own it with a $30 cost basis. That's an example of a 1 month expiration contract. The same applies to long-term contracts. Let's say the price is $35 and you sell put options with an expiration period of 3 months and you get paid $5 instead of $2 in the upfront. There are too many variations of this contract selling, but the logic behind this strategy is the same. to own the shares cheaper than the market price. The next step after buying the shares at $30 is to wait. As I described it in my other videos, the best thing an investor can do in many situations is to wait. As Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. In investing, we should learn to wait if we want to be successful. So we wait until the stock price reaches about $55 to $57 to be able to sell it at $60. The opposite thing is done when the price reaches closer to the levels where we want to sell. Let's say the price is trading at $56 now. By the way, smash that like button if you want to show your support to this channel and you are getting value, and also that will help us do more videos for you. The next thing I do is to sell call options on the stock I own at a strike price I want to sell. In this example, I'd sell call options with a $57 strike price for which I'll get paid $3 per share in the upfront. And as always, three things can happen. The price can go up, down, or stay sideways. In the case it goes above $57, I will have to sell my shares at $57 and I'll pocket the $57 per share and the $3 per share for the option contracts I sold and got paid in the upfront. So selling the shares and the options contract together will bring me $60 per share. And if the price stays sideways, I will just pocket the $3 profit and will sell new call options again for another period. And in the case the price drops, I will continue waiting for the price to go up as I did before, but again with $3 profit per share, which will make my cost basis deducted by $3 per share. So still I will be happy in all directions. No other case can happen. And this strategy is called a covered call strategy, which again becomes very powerful if you combine it with value investing principles. Again, many people lose a lot of money doing it wrongly. To sum up, I pay $30 for a stock which is trading at around $33 to $35 price range. And I sell the share and I get $60 for a stock which has reached $55 to $57. So the price moved about $20 to $24, but I made a profit of $30. And $30 is the minimum I make on this price movement, as this is the case where all the contracts I sold on the first trial got exercised. Imagine a situation where you sell an options contract and the price stays sideways, you profit the premium paid in the upfront and then sell options again, and the price remains sideways. This way the $30 profit is the minimum to make, as every time you sell an option contract, the cost basis to own the stock is deducted. It can go to 27, 24, 21 and so on each time you sell the contract until the shares are put into your portfolio, so that the profit can go from $30 to $33, $36, $39 and whatever on the stock price that moved about $20 to $25. A mistake I used to make was to sell call options on the stock which is trading below its fair value. In this example, if I start selling covered calls when the stock price was trading between $30 to $40 ranges, I may lose my opportunity to be invested in a very wonderful company and gaining from stock price appreciation. Because when the call option expires in the money, I am obligated to sell my shares at a promised strike price. It is a very annoying situation when you deeply analyze a company, love to own it, wait for it to drop in price, later buy it and sell it very soon without giving it enough time to rise in price. So selling call options very soon can be very confusing for a long-term investor. There are still two significant questions to be asked here. The number one question is how to find the safest buying price of a stock which is trading below the real fair value. For that, you can click on the card to watch my video where I explain step by step how to calculate the intrinsic value of a stock. And the number two question is where I learned this option selling strategy. And my answer is that it's what Warren Buffett does all the time. And you better click on the card here to watch my video where I explain how Warren Buffett makes billions of dollars with this simple strategy. So make sure you subscribe and hit the bell icon to get notifications when I upload the new video so that you don't miss it. And if you could take any value from this video, hit the thumbs up button and share with your friends. And now please leave your comments below about your preferred option selling strategy. Thanks for watching. Watch the next video.